Welcome to The Explainer. Today, we're not just looking at the UK property market, we're giving you a blueprint for 2026. And you're going to want to listen because the old rules, they're out the window. The market is at a huge turning point, and for smart investors, that means opportunity. We've got the data, the strategies, and the new rules you absolutely need to know.
So, let's just start right here. This single quote from Prop Intel's latest analysis, it says it all, doesn't it? The old playbook of just buy in London and wait, well, it's being totally rewritten. For the first time in a long time, the best places to put your money are nowhere near the capital.
And what's interesting is this is all happening as the market starts to feel a bit more stable. With the Bank of England's base rate holding steady at 3.75%, mortgage costs are finally calming down. For investors, this is basically a green light, a signal to start looking beyond the usual suspects and really follow the data.
And to help you do just that, we've laid this explainer out like an investor's funnel. We're going to start big picture, looking at the major market shift. Then, we'll drill down into the data to find those hotspots. After that, it's all about strategy, navigating the new regulations, and finally, a practical playbook to get you going.
Okay, so let's get into that big picture. The investment map of the UK is genuinely being redrawn. We're seeing a massive shift in focus, moving away from those traditional, super expensive areas.
Yeah, the key thing here is what some people are calling the London exodus. For years, London was just the default choice, right? But now, with sky-high prices and rental yields that just can't keep up, investors are realizing their money works so much harder in the regional powerhouses up north, in the Midlands, and even in parts of Wales.
So, if it's not London, then where exactly? Well, this is where it gets really fun. Let's forget opinions and just look at what the numbers are telling us. So, to find the real hotspots, we're not just looking at one thing. We're using a data-driven investor score from Prop Intel. Think of it like a recipe for a good investment. It's heavily weighted towards rental yield, that's 30%, but it also balances that with rental growth and price growth at 25% each. It's a really smart way to get a full picture of an area's potential.
And look at this. This perfectly illustrates that shift we were talking about. The results are kind of wild. Right at the top, you have Blaenau Gwent in Wales. Then you've got two northern giants, Newcastle and Manchester. This is hard data showing a complete shakeup of the UK's best investment spots.
Now, what's really cool here is that this shows there's no single type of opportunity. On one hand, you've got Blaenau Gwent, super low entry price, but it's being fueled by a massive regeneration project called The Works. Then, on the other hand, you have a major city like Newcastle. Its market is buzzing because of a huge student population and its growing status as a major hub for life sciences. Two totally different stories, both delivering fantastic returns.
Okay, so you know where to look. The next big question is, of course, how are you going to invest? The right strategy for you really depends on your goals, your cash, and honestly, how much work you want to put in.
So first up, we've got the classic buy-to-let, BTL. This is the bedrock strategy for most UK investors, right? You buy a place, you rent it out, and you aim for that sweet spot of monthly income and long-term value growth. It's perfect if you're looking for a relatively hands-off way to build wealth.
Then, on the complete opposite end of the spectrum, you've got flipping. This is an active, short-term play. It's not about rent checks. It's about buying something that needs love, adding value through a great renovation, and selling it fast for a nice, chunky profit. It's a higher risk game, for sure, but the rewards can come much faster.
And then there's this really powerful hybrid method called BUY. It stands for buy, refurbish, refinance, and rent. This is the strategy for people who want to build a portfolio and build it fast by basically recycling their initial investment over and over again.
So how does it actually work? Well, it's this really clever four-step loop. You buy a property that needs work, and then you refurbish it to force its value way up. Now here's the magic part. You then refinance the property based on that new, higher value. This lets you pull most or sometimes all of your original cash back out, ready for the next project, all while the first property is rented out and making you money.
This table really sums it all up. You just have to ask yourself, what kind of investor am I? Are you looking for stable, long-term income? Then buy-to-let is probably your game. Are you an experienced renovator chasing that big one-off payday? Flipping might be for you. Or are you a hands-on investor who wants to scale up fast? Then you've got to master BRRR.
Okay, before you get too excited and jump in, we have to talk about the rules of the game. And this is absolutely critical, because right now, the rulebook for landlords is going through its biggest change in decades.
The main thing you need to have on your radar is the Renters' Rights Bill. This thing is set to completely change the relationship between landlords and tenants in England, and it puts a lot more responsibility squarely on the shoulders of the property owner. So let's break down the big impacts. The headline grabber is the end of so-called no-fault evictions, or Section 21s. This basically means landlords won't be able to end a tenancy without giving a specific, valid reason once the initial term is up. You'll need a legitimate reason, like you want to sell the property or move in yourself. The bill also makes it easier for tenants to challenge rent rises and just generally boost their protections. The bottom line? Being a landlord in 2026 requires a whole new level of professionalism.
Okay, we've covered the shifting landscape, the hotspots, the strategies, and the new rules. So let's wrap this all up into a practical playbook, your next steps.
First things first, a super important financial rule. Gross yield is not your profit. You've got to run the numbers on the actual deal, with all the costs factored in, especially taxes. Don't forget about stamp duty land tax, that's the tax you pay when you buy, and the extra surcharge you pay for any additional properties. Seriously, these costs can make or break a deal, so they have to be in your spreadsheet from day one.
And here's how you turn all this data into an actual investment. First, match an area to your strategy. Then, model the real net profit. And this is a big one. Look for areas with strong rental growth, because that's where your returns will really compound over time. And finally, and this is non-negotiable, you have to back everything up with on-the-ground research. The data tells you where to look, but local knowledge tells you what to buy.
So there you have it. The 2026 market is clearly rewarding investors who are willing to think differently, to look beyond the obvious, and to follow the data. The numbers are pointing to huge opportunities in places like Blaenau Gwent, Newcastle, and Manchester. So the final question is pretty simple. The data has shown you where the opportunity is. What's your first move going to be?